Understanding long-term assets, key components and implications for financial analysis. Long-term assets, also known as non-current assets, play a significant role in the financial health and operational strategy of a company. These assets provide benefits for a period greater than 1 year and typically include tangible fixed assets as well as intangible assets. This article explores the nature, types, implications, and limitations of long-term assets, providing insights crucial for investors, analysts, and business managers. Definition of long-term assets. Long-term assets are vital components of a company's balance sheet and contribute to its stability and growth potential. They are categorized into two main types. 1. Tangible assets. These are physical items that can be touched and seen. Examples include property, plant and equipment, PP&E, machinery, buildings, vehicles. 2. Intangible assets. Unlike physical assets, intangible assets represent non-physical items that still carry significant value. They include long-term investments, e.g., stocks and bonds, patents and copyrights, trademarks and goodwill from acquisitions, software. Importance of long-term assets. Understanding long-term assets is crucial since they reflect a company's investment in its future growth and stability. While these assets are typically recorded at historical cost on the balance sheet, they may not always indicate their current market value. Investors often analyze changes in long-term assets to gauge a company's capital investment strategies or to identify potential liquidation efforts. Key takeaways. Long-term assets represent investments that will benefit the company over many years. Changes in long-term assets can suggest either capital investment strategies or efforts to address short-term liquidity issues. Current versus long-term assets. The differentiation between current and long-term assets is fundamental in assessing a company's financial health. Current assets. These include all assets expected to be converted into cash or consumed within 1 year. Examples are cash, accounts receivable, and inventory. Long-term assets. These assets are designed for continuous use by the company over a period extending beyond 1 year. They are less liquid than current assets, as they cannot be easily converted into cash. Illustration: balance sheet composition. A company's balance sheet will typically show current assets at the top, followed by long-term assets. Understanding this composition helps stakeholders evaluate how effectively a company leverages its resources for growth versus operational needs. Depreciation and long-term assets. Depreciation plays a key role in accounting for long-term assets. This accounting method allows companies to allocate the cost of tangible assets over their useful lives, providing a more accurate view of an asset's value compared to simply tracking its initial purchase price. Methods of depreciation. 1. Straight-line depreciation spreads the cost evenly over the asset's useful life. 2. Accelerated depreciation allocates more expense in the earlier years of an asset's life, recognizing that the asset may provide more benefit in these years. Depreciation is a vital non-cash expense that can impact a company's net income, and analysts often reference metrics such as EBITDA, earnings before interest, taxes, depreciation, and amortization, to assess the company's operational performance devoid of volatility caused by asset depreciation. Limitations of long-term assets. Despite their importance, long-term assets also come with limitations. 1. Financial strain. Investing in long-term assets usually requires substantial capital, which can drain cash reserves or increase debt levels. 2. Delayed returns. The benefits derived from these investments may not be realized for several years, necessitating trust in management's capacity to execute growth strategies effectively. 3. Not all assets drive earnings. Just because a company invests heavily in long-term assets, it does not guarantee increased profitability. For example, pharmaceutical companies spend billions on research and development, yet only a few new drugs will successfully reach the market. Practical case study, ExxonMobil Corporation, XOM. To illustrate the concepts of long-term assets, we can examine ExxonMobil's balance sheet. As of September 30, 2018, Exxon reported significant long-term assets totaling approximately $300.653 billion. Breakdown of long-term assets. Investments and long-term receivables, $40.427 billion. Property, plant, and equipment, $249.153 billion, including oil rigs and drilling machinery. Other intangible assets, $11.073 billion. This example underscores how a substantial portion of Exxon's balance sheet is allocated to long-term assets, highlighting their commitment to sustaining future growth while portraying their financial position to investors. Conclusion. Long-term assets are a critical aspect of a company's financial framework. Their role extends beyond mere accounting figures. They signal a company's strategic direction and operational health. Investors should conduct thorough analyses of long-term asset allocations and their implications, integrating multiple financial ratios and context to gain a comprehensive view of a company's viability and future potential. By acknowledging both the contributions and limitations of long-term assets, stakeholders can make informed decisions about investing in or managing these vital resources.